course of today's session, we're going to break it down into 3 core parts. First part, we're going to look at some historical reasons why options in Asia Pac have attracted such significant growth. Secondly, we're going to take the opportunity to review some of the trading activities and maybe some of the lessons learned during the first quarter volatile activity that we saw this year. And then finally, we're going to ask the panelists to see if they can look into their crystal ball and give us a prediction in the next 2 to 3 year period where they feel that the option market is going to take us, particularly in Asia Pac and potentially globally as we move forward over the coming years. But before I start, I'd love the opportunity to introduce the panelists. And Govert, could I ask you to start, please?
Hi, my name is Govert Heijboer. I'm co-CEO of True Partner Capital. We are a volatility hedge fund asset manager.
Great, thank you. Josh?
Hi, my name is Jos. I'm head of market making APAC at Maven Securities. We're derivatives market makers on Hong Kong Exchange and Japan Exchange.
Great. Charles?
Hi, I'm the managing director for Optiva China. I'm in charge of the operations for Optiva in China. We are an options market maker. We are a global firm. We have APAC operations in Sydney, Hong Kong, Taiwan, and then China. We're based in US in Chicago, and then Europe in Amsterdam.
Thanks, Charles. And finally, Chris.
Hi, I'm Chris Lee, Global Client Development at Hong Kong Exchange, with a focus on looking after the proprietary traders, market makers, liquidity providers, and HFT business.
Well, thanks very much, gentlemen, for taking the time to join us. I noticed that most of us are based in Hong Kong, with the exception of Charles, who's joined us from Shanghai today. So let's start off on the first section. We want to explore some historical reasons why options in Asia Pac have attracted such significant growth. I'm going to address the first question to Govert. You set up your fund based in Hong Kong. You're very much focused, on the option market. What were some of the driving factors that attracted you to setting up your fund the way that you have at the moment?
Well, for us, being based, we have offices in Hong Kong, Chicago, and Amsterdam, but our main office is in Hong Kong. I think for us, the interesting part of being based in Asia is that, let's say, the markets, the equity markets, but especially also the option markets, in a way are much less, let's say, homogeneous than in other parts of the world. Because here in Asia, you can trade markets like, of course, the Hong Kong Exchange, Hang Seng and H shares. You can trade Australia, you can trade the Nikkei and Kospi, and they all have their own specific characteristics, which makes it very interesting for volatility trading.
Thanks. And Charles, specifically to you, being based in Shanghai, obviously, you've decided to go early, if you like, into Shanghai to get set up in China. What was the driving factor for you to set up in Shanghai as opposed to, say, Hong Kong or Singapore?
Yeah, I would like to talk a little bit about the history. So when I first joined the firm as a trader back in 2001, I clearly remember that at that time I was having a chance to trade the Hong Kong exchange product. There was only a few equity single stock options that would be in Hong Kong Exchange, China Mobile, China Unicom. Those are the 3 main ones, and then you have HSI index options. And later on, they add on the HSCI index option. And you can see the growth in the last 20 years is enormous on the equity base of the options in this area. With the options participation, it sort of helped with the underlying itself. It helps its own futures. And then with the options, it's almost like a 3 legs that's supporting the entire market. And then I had a chance to go to Taiwan to set up the Taiwan operations. So in Taiwan, similar things when early on, they only have the TAIFEX index options, and with a very small volume. It's predominantly a very retail based market. But then it also grows over time. It attracts international participants. It attracts the hedge funds, and even for some bankings and insurance local banking and insurance to hedge their equity positions. They use quite a lot of options to manage their own risk. And back into a China operation, we came to China in late 2012. China doesn't have option products at that time. The first option products in China was launched under the SSE 50 ETF options back in 2015. At that time, it was just mainly for the market to want option products, for the regulators, for the market to understand what an option product is. So if you look back for the first year, the average volume on that product is like 200,000 contracts a day. If you look at the numbers for let's say March this year, for the equity option itself, it reached 134 million contracts. So less than 5 years, it's grown from 200,000 to 134 million contracts a day. So you can see the demand for options products in China market, in the whole Asia Pac market, grows significantly over the last couple of years. It can be because of the hedge funds like COVID, could be the banks and the insurance to manage their own position, the retail clients coming in as well. Also from regulators, like especially in China, on some of the commodity options, the regulators was really behind and support the launch of those commodity products. They see it as an insurance product, similar to the US back to the days that they issued for the farmers as an insurance product to hedge their crops. And this is basically a bit of a background of the options product development in APAC.
And I think more importantly, and we'll talk about it a little bit later in the session, with mainland China at the moment, we don't have the traditional global inbound business at the moment, do we? You know what I mean? It's more domestically orientated at this particular point with funds like yourself who are physically onshore. So we'll explore that a little bit later in the session about potentially opening up of China and tapping into that growth that you've spoke about today. But Josh, particularly with you, I mean, Maven's been in Hong Kong for a number of years. You've just recently moved offices into bigger space, so obviously you're committed to that area. And you're particularly focused on market making as such. I mean, what drove you to Hong Kong, and more importantly, setting up a market making business around the options here?
Well, market making options is an interesting game, especially when you compare it to, say, a Delta One product that is a very one-dimensional product. People buy it because they want to have directional exposure to something. When you look at options, there is many different reasons that people buy or sell options. It's a very multi-dimensional product. People trade it for underlying exposure, volatility exposure, maybe even skew exposure. And then also there's an expiry date, which makes everything a lot harder. So there's time decay. Like, it comes down to options being pretty risky instruments if you just trade one of them or like take an outright position into options. The beauty about options is that different options are very good hedges for each other. And you can construct a portfolio of long and short options to sort of neutralize all the individual Greeks that you get from trading an option, which sort of makes it a very interesting product to market make. It becomes pricing of volatility, which is basically the main input in your option pricing, becomes very important. And it's not always an outright speed game. Whereas if you think about Delta One products, they're a lot easier to price, and just speed and execution becomes a lot more important. So that's why we've always focused on options products. Hong Kong specifically, I mean, some of the reasons that Charles has mentioned already, like there is, in Asia, this is a big demand for option products and any sort of financial products really, but yeah, there is Hong Kong Exchange, Japan, Korea, India, onshore China. There's just volumes are just growing everywhere. And that's not the case everywhere around the world, I'd say.
Chris, just for you, because you represent the Hong Kong Exchange, obviously a big part of what you're doing in the development work has been around the option space. What type of clients have you found and investors have you found, wanting to access your products over the last year or so?
So I guess we're feeding the habit that Charles's and Govet's and Joss's firms have in terms of options. But outside of the traditional market making or the fund businesses, we see the banks using them terrifically. But there's also a huge retail sector in Hong Kong that actually uses warrants. Uses options, and the warrant side of things creates its own demand because there's a huge structured product business here. So I mean, if you look through the products we actually have options on, that we've listed options on over the years, you're talking everything from ETFs to currencies to obviously the stable index futures, indexes, and then the stocks. So I think it's built such an array of client base that Hong Kong itself has become quite known for its option businesses. And as the guys say, the clearers are here, the market makers are here, and it's quite diverse.
Thanks, Chris. And Govet, I'm going to come back to you because you have attracted a lot of new investment, into your fund over the last, year. Going back to what Josh said about options being perceived to be risky, I mean, what's your thought? How did you get that past your investors? I mean, what's the strategies you put in place to mitigate some of those risks?
I think Jos referred to a number of things already. When you have, let's say, multiple option positions, then you can construct them in such a way that the risk of the position as a whole is not necessarily as risky as just having one particular option or etc. I think for us, we have seen large inflow over the last few years. We only focus on institutional investors. Actually, for us, the main interest comes, interestingly, not so much from Asia as it is from Europe and the US. Although we do trade a lot in Asia. I think what they find interesting about our particular strategy is that we, as a volatility hedge fund, we only focus on exchange-listed products. And this obviously, apart from, let's say, the risks of the positions that we have, at least has the advantage compared to, let's say, more OTC products that everything is relatively transparent in terms of pricing and the NAV that we have for our funds. And also I think, going forward a bit, maybe what we saw in the first quarter this year, liquidity-wise, it's also interesting if you only trade exchange-listed products because especially given the larger retail base here in Asia, what you did see is that even in stressful market circumstances, liquidity is still reasonably good in shorter dated exchange-listed products like we trade in.
That's actually a perfect segue into the next section around some of the lessons that we learned, in the first quarter. Charles, what's your thoughts? I mean, unprecedented volatility in first quarter. You were in mainland China, focused on those domestic markets. I mean, what were the key lessons you learned over that quarter?
If you look at the China market alone, I think the pandemic hits China first, and after the market got delayed open for a day, then market resumed on the 3rd of February. At that time, I would say the volatility is high, but at the same time, the volume is actually quite low. I think people maybe still try to figure out how to access to the market from home rather than from office. You don't really see extreme volumes going through back in February. March is a little bit different. I think March went the market in China, or I think people's in China is more settling down, knowing how to get the business running again. And then the pandemic hit globally. I think the global market reacts a little bit stronger than the local market. What we noticed during that March period, the volume is definitely coming back, but at the same time, at different moments that you have a liquidity issues on screen. So you can see the spreads getting wider, and when the volatility shoot up for a short period, you may not have the other side to fully facilitate that demand. That has to do a lot with the cost of capital. I think currently within China, the regulators takes it quite cautiously on launching those options products. They also in the pathway to understand the behavior of the product, so they charge quite high in terms of margin, and the facilitation of margin offsetting is not that well. They haven't started using so-called span margining system. The short margin charge is extremely high, so it actually requires you a lot of capital to provide liquidity back to the market. I think that the regulator in exchange sees that, and they're working on it. This also applies to option markets in a bit more developed market as well. For example, Hong Kong, Japan, and Korea, or even Taiwan. We also see the spread gets wider. I would also touch on the points that to Chris, like we're working with Hong Kong Exchange quite a lot on the short option margin issue that comparing to other exchange at the moment, Hong Kong Exchange charged slightly higher on the short option margin. In that perspective, I know Hong Kong Exchange is working on that. What we try to point out as a market maker is the cost of capital, or the efficiency of using capital, is very important for us to provide efficient and effective pricing and liquidity back to the options market. And the worst thing that you want to see in an orderly market is a lack of liquidity, and that actually causes a lot of trouble to the market. It's not the daily volatility of movement that may cause problems to the market. It's actually the liquidity. Where can we get the liquidity into the market? That's where the orderly market needed.
Fair enough. Now, Josh, back to you. Did you find something similar, obviously based in Hong Kong, and the markets during that particular time? Was liquidity an issue for you? And if you've got any view on, the service providers that support your account, I mean, issues maybe with PBs or FCMs in particular who are servicing your account, any challenges that you saw over that period?
I'll start with your question on liquidity. It makes sense to me that that market makers or anyone really charges a higher spread in this kind of environment, with volatilities through the roof, and volatility itself being very volatile, as well as the underlying being very volatile. That the spreads on exchange will just, as a consequence of that, widen, because as a market maker, every trade you do, you take on more risk, and you're less certain of how you will get your hedge. Some of the points that Charles made definitely made sense, especially like 8 share short option margin is always a worry for me. I think it's too high, but that's probably a discussion outside of this the scope of this this conversation. Pure liquidity, I think that what happens, we found that most of our counterparties, they become sort of less price sensitive, and they would just trade at the first trade that happens during the day. Often in the IDB, like they call the broker and say, I just need to buy this at a level, and then the level gets found, and then as soon as there's a traded price, then everyone will just jump on board, because there is a small pocket of liquidity that everyone can participate in. That was sort of a bigger change from before. In terms of PBs, or other service providers, you obviously have to communicate more with them, because if some of their stress scenarios are, let's say, an X% underlying move, on a normal day it doesn't happen very often, but on a day in March it probably would happen like 2 or 3 times a month, no problem. So whatever position you have inherently become more risky due to the higher volatility, and there are some more structural measures on how they allocate their capital, and something that most PBs refer to as leverage ratio, which sort of indicates how many strike positions you can hold across your term structure. That became very hard to manage for most market makers. But on the whole, I think, referring to what Govert said earlier, like the exchange traded products still functioned as normally. It just, you had to improvise here and there, but compared to like an OTC market where all the liquidity suddenly evaporates or anything, I didn't see that very much.
Great, that's great feedback. And Chris, for you, during that period, obviously it was extremely busy for everyone in the market, but specifically at the exchange level, like yourself. What were some of the issues that were focused on? I've heard a theme here around margining. Obviously, exchange margins did go up over that particular period of time. What was the lessons learned, or some of the stress points that you faced as an exchange?
Yeah, look, I think with margins, we're quite conscious that we want to put stable margins in there, that we don't move around sporadically in normal markets or slightly stressed markets. But we were in a different time though, in that period. So I think some margins did change for sure. But I don't think it's not something we do lightly, and it's certainly not. We don't try and keep low margins and then try and and then move them up when we urgently have to and move them back down again. We try and keep a very stable margin level, which I think most people would accept. The other thing on stability, I think one thing we were obviously very conscious of with the volumes was keeping the market running and keeping it stable and making sure we had 100% uptime, which we did. I think lessons learned. I think we're working currently on an idea, because as Jos alluded to, spreads get wider, market makers have trouble meeting their obligations in some respects, and that's simply because of a methodology of the volatility or the cost of borrow, whatever adds to their stress there as well. So I think we're looking at ways we can kind of work some kind of fast market activity for next time if anything like this happens, and then we could perhaps widen spreads out. And it's a trade-off between widening spreads out a little bit for the investor to actually be able to hit the spreads than just losing all the spreads together, because you don't want to lose all your market makers together. So I think we're trying to balance that out in the future by building some kind of fast market methodology. But overall, the market was very stable. It performed. It worked. We had people obviously not in the office, most of the people at the time of the stresses, and it performed. So I think we were fairly pleased.
Mm. And Govert, just for you, obviously you run a small office, small trading team, you run a pretty lean operation. Working from home posture, how did you guys manage that in particular in your organization? And was it a challenge for you as you sort of continued during those busy times?
I guess it's a bit similar to everyone else. Obviously, I think for us the main thing was that we had to deal with all kinds of different regulations, because obviously, when you have an office in Amsterdam, in Chicago, and in Hong Kong, in each jurisdiction, they came up with different kind of measures or different kind of ideas on how to deal with the COVID. In all honesty, for us, it was not so problematic. We already had working from home setups in place for most employees prior. I think, specifically for Hong Kong, not to go into politics too much, but having had the protests half a year before, in a way sort of helped making sure that all our continuity plans were in place, because we double tested them for another reason. So that actually helped things go pretty smoothly in March in that respect. Separately, also for the operational risk part, it was not so much for ourselves, but also, of course, sort of a double checking on all our service providers, like market data, prime brokers, administrators, make sure that obviously they had similar good policies in place so that we could continue as a business in that respect. It was also fine, actually.
No, I'll have to admit, I mean, overall, the market activity was unprecedented, as we would all know. But, you know, when you had 80% of our staff really across the street working from home, it was pretty seamless, to be honest. I mean, obviously, you know, we had some busy times and we had to manage risk as we go through. But, you know, it's almost the genie's out of the bottle almost, isn't it? Do you know what I mean? Like, we've now proven as an industry that we can operate remotely and we can run as we go. You know, Josh, for you, you know, is that going to change the way that you see staff operating in the coming years? I mean, or do you think as soon as the restrictions are lifted, you'll all be back in the office as BAU? I mean, what's your thoughts looking forward?
So we've been lucky enough to keep most of our traders in the office almost all of the time. We had some support staff work from home, or most of the support staff work from home, but the market making traders managed to stay in the office for most of the time. I do think there is a benefit on having traders in the same physical location, because it just enhances communication, and it also makes it easier to, let's say, teach juniors or something. But I do think that in the past we've probably been too rigorous on that. I think in certain cases it makes sense for people to work from different physical locations.
And Charles, in China, what was the feeling for you? Where, you know, was it the same like on Josh, were the traders sitting in the office and support staff at home, or were you calling the shots from home? How were you set up during that particular period and during the lockdown?
Yeah, we were pretty much working from home remotely. At that time, from a regulatory perspective, it's actually not allowed to go back to the office. So China in Feb and March, it was applied a much stricter restrictions on people gathering together. So a firm like us, we have continuous testing on continuity plans. So the whole operation is quite seamless to operate from home. For the long run, I agree with Josh that we see benefits of getting everyone together. So once a government is allowed, that we're quite quickly to move people back, and people are actually happy to be gathering together rather than work from home. Globally, I think on top of just our own continuity plans, there's quite a bit of a communication that we need to do with regulators, because we are important financial participants. We hold the license. I felt that not all regulators prepared with this kind of working from home arrangements. So there's a bit of a communications and getting approvals need to be done for us to be able to work from home and provide liquidity back to the market, not from the office.
Fair enough. And Chris, as an exchange, I mean, you've still got large numbers working from home, or what's the posture at the moment?
Today is the first day we're pretty much all back, to be honest. I think we're 80-20 in the office, which is literally today. But I think during those times we were 90% from home. And I think if I'm honest, some of the creativity is lost. But actually, the moment when it all went crazy out in the markets, you don't need creativity. You just need to get the job done. So I think we were fine, and we actually pulled off a big deal while we were all working from home, which is quite unbelievable. But as Gervert says, we've kind of got practice to it. So no, we're back to the office literally today, pretty much.
It's funny you say that. Actually, I was in my own situation. I had a small crisis I had to deal with, and it was very challenging to do it from home on my BlackBerry and set up. So I got approval to go straight back into the office to deal with it. So, you know, what I'm hearing from everyone is, look, we can do it. We have a well-defined BCP plan now, but the overall preference is to have traders and staff back in the office. So, I would agree with that. So fingers crossed over the coming months, we'll slowly work back to normal as we get through. Before I move on to the future, I just want to focus really around, again, I just want to touch on the market making functionalities and some of the markets out here. Josh, if I can go back to you, you mentioned Hong Kong, Korea, other markets around. Did you find any particular market over that busy period, market making was more successful than others? Or do you find that these days, most of the exchanges are all fairly, your models work evenly across regardless where they are in Asia?
So at the moment, we're only active on OSE and on Hong Kong Exchange. I wouldn't say that one would get particularly a lot more busy than other ones, or exchanges would outperform other exchanges. I think a lot of the volume is spread out between those two exchanges for us anyway. I think the liquidity on Osaka Exchange was probably a little bit better when it was really busy. It could have to do with the market making schemes that Chris referred to, was that the Hong Kong Exchange has a pretty well-defined market making scheme and how wide you need to quote things at certain size, which just wasn't wide enough during that busy period. And at some point in the month, you know that you're not going to make your market making obligations, so people won't try and do this anymore. And that's why maybe there was some volume that Hong Kong Exchange was missing out on. In Japan, we didn't have that problem. They were more lenient immediately with the market making schemes.
And Govert, I know you're volatility, not market making, but the same sort of question to you. Did you find a particular market in Asia, better than others, or again, same question, or did you find that the maturity of markets across Asia now is such that your models work regardless?
So I do have a market making background before we started our volatility hedge fund, so I can relate to the quoting that you have to do in difficult market circumstances. So yes, if the spreads are too tight that you have to for your obligations, then things become a bit difficult. Well, I think what you do see here in Asia, obviously, that the depth of each market in Asia is a little bit different. Hong Kong Exchange has a pretty deep market, but I think historically, like in the Nikkei options, it's just a little bit deeper. Korea has very high liquidity, for instance, in the front months because of retail. So every market has its own peculiarities. And what you see during busy times is that, it's very logical, like Jos said, that spreads widen and you need to pay up a bit more if you want to take position, etc., or unwind position. So liquidity at certain times becomes a bit less, and obviously it's not always exactly at the same point in time on each market, because for various local circumstances it can be the case that suddenly, I would say, the level of panic, let's say, is slightly higher in one particular Asian market than in the other one. But I would say on average, even during busy periods, it's roughly the same. I would say the same proportion. So obviously a market like the S&P 500 continues to be one of the deepest markets. During busy times, it's still one of the deepest markets. Maybe it's a bit less deep, but so are all the other markets. So in proportion to each other, I would say it's quite similar, with occasional hiccup here and there because of a local additional panic or situation. Yeah.
No, that's good feedback. And Charles, I'm going to ask you to look forward now. Obviously, you've spoke about incredible growth in mainland China since you've been there in the last 5 or 6 years. But as we mentioned earlier in the session, global inbound doesn't really have the ability to gain access to it at this particular stage. What's your thoughts of the market opening up? What's your thoughts about where we're going to see access to all that liquidity in the next 3 or 4 years?
First, I can't speak on behalf of the government. So the China business, we have to listen to the government. So I think that they definitely do have agenda. I think where we at the moment, I think we at the moment on options market for the regulators, for the market participants, for the local market makers to understand the option market, to understand the effectiveness of the option market, what could be the potential problems that this market may bring to the Chinese market alone, to the Chinese financial market. So I think the market is definitely learning itself. And then you can see it in China, because of the 1.4 billion people, because of the GDP size, even when it's learning internally, not having much a global participation, the volume is already a pretty high, which I think it's a good thing because it speed up their learning process, right? So the participations helped quite a lot. So that's where we at. So looking forward a little bit, I would say two things are quite interesting. One is the Sino-American, I would say the geopolitical tension, right? You can see one side, it's more saying, it's America first, a bit more inward looking and try to protect its own interest. China, on the other hand, is emphasizing globalization, continues to opening up and try to attract more interaction between the local and foreign in the financial market. I think going forward, the speed of opening up, the speed of welcoming international participation to the local market is going to be fast. That's the first takeaway. The second part is I'm not sure people notice down here, when we are talking about options market, because of this panelist group, we all focus on equity options market, right? So when we talk about Hong Kong Exchange, it's very equity based. Osaka, equity based again. Korea, equity based. In Taiwan, the index options, equity based. So in Asia Pacific alone, all the options market are very focused on the equity based. It's only in China that's different. Half of close to 40% of the options market currently transact each day in China market are in commodity space. Right. So that's a huge a liquidity pool, different to what we used to participate in. And the commodity space is a global product compared to equity. It's a bit more regional based. That's why you see slightly different participation in Osaka and Hong Kong Exchange, because they just have a different economic interest. But with the commodity products, that's going to be quite global. Gold, it's the same gold. Oil is the same oil. So that's where the potential growth can be very different in China versus other regional exchanges.
It's a very good point, actually. You're right. I mean, I spend a lot of time, explaining to our global business how amazingly equity focused Asia Pac is, and and looking at how we could potentially expand on the fixed income and the commodity space. And to you, Chris, is that something that's on your agenda? I mean, obviously you on the future side, you're launching a lot of the MSCI products. You're setting yourself up as a access to China type sort of exchange as that expands. What's on your immediate horizon specifically with options?
So I think if you just go back 9 months, we were launching our weekly options on our indices, which have done fairly well, at great success. And I think we've got Maven and Optiva both in there for the day session, and we've got those in the night session now. So I think weeklies in general could become more of a feature, perhaps in other asset classes that we've got. we've moved more to, I mean, we've always had single stock options, obviously, but for the first time recently, end of last year, we started listing single stock options on some of those big IPOs we've been doing on day one, which wasn't easy because the market maker, will struggle to get a borrow day one, but we were trying to work out how we could get that borrow sorted out. So we've now got that as a fluid activity, which is great for some of the big IPOs that we've been doing, with the Alibabas of the world and so on. And then I think more to Charles's point, I think if you look over the water to London, our sister company, LME's trying to grow the option space on their commodity market. And I think anything that we could get a liquid future in, for sure, we would want to put options on. And have you seen any, indices out there, any new indices arriving in the land, then if we can put futures on them, get them liquid, and then put options on them, that's certainly on our agenda, because I think we believe we've got that ecosystem for options. We love the fact that then ETFs get spun off of them and we can get options on those ETFs. We love the fact that structured products can get spun off those and actually help the options market, and it feeds the futures. So I think anything we can get liquid futures running on, we'd probably try and put options on. It's a bit generalised, but answer your point without telling you too much.
Call. No, it's a great call. Govett, I know you've mentioned a couple of times, your desire to do more business in the weeklies in Hong Kong. Is that your focus? I mean, what else is out there at the moment on your immediate horizon?
Yeah, so actually one of the points Charles mentioned, so for us, we mainly focused on equity indices at the moment, but slowly as a company, we're also looking into the commodity space as well. So unfortunately, from outside China, indeed, it's still not possible to tap, let's say, the onshore option markets. But yeah, if that would ever open up, that would be a very interesting thing for us. I think it's a general trend, and for us, basically, we are like, not all similar to market base, but we're like a 24/7 kind of hedge fund active trading strategy. So for us, what we see, the continuation of having more volume in night sessions, and indeed what you see in general, the focus nowadays in the world is to more and more short term. So we have weeklies options, like in the US, you even have daily options now, or Monday or Wednesdays, etc. So we probably see that trend to continue as well here in Asia. I think sometimes some regulatory or other things makes it slightly difficult to get these weeklies launched properly, and of course it always comes with some infrastructure and some little hiccups to overcome. But yeah, what you see now in Hong Kong Exchange, weeklies are picking up a little bit. In Korea, similar thing. So yeah, we believe that will continue as well, and that's interesting for us.
Great. And Josh, just as we're coming to the close of the session, I'm going to give you the last comment, if I may. Just again, looking forward, what are the couple of things that you particularly focused on, from your business plan? Can you give us some insight over the next couple of years, where you're going to maybe spend your tech dollars, if that's what you are? I mean, what's your thoughts?
So we're moving forward to become market makers on the single stock option range of products on Hong Kong Exchange. I think Chris mentioned, like, there's just a big boost in that market happening at the moment, with a lot of Chinese ADRs moving home, as they say, which is bringing a lot of more products to trade. So that will be interesting for us. We would also, because we then have the connectivity, we'll do warrants and CBBCs, which are sort of retail-based products on Hong Kong Exchange. I would hope that one day maybe they can be traded through the Stock Connect by Chinese retail. That would be beneficial, I'd say. Also, I mean, this is nothing that has been launched yet, but I saw the HSI Tech Index has been launched. I think Chris needs to do some work on introducing futures and options on that. I think it can become. I think that can become like the Nasdaq of Asia, if you will. But that's more up to the exchange than up to me, I guess.
Yeah, we're very supportive of that new contract coming through, CFTC approved, et cetera. So we'll wait for that space for Chris to be able to make some announcements as we go through. So, no, I agree. So it sounds like, in summary, if I can, gentlemen, is, there's a lot of liquidity in mainland China. We've got a lot of established, very well established players here in Asia. And it seems to be that, most of us are looking for access into new liquidity and looking at new markets where we can access that liquidity. Because of the maturity that we have in the market, we've proven that we can handle the volatility over the first quarter of this year. And obviously, the future over the next couple of years will be about plugging into, new pockets of liquidity and more importantly, new investors coming into the market. So it's a very rosy picture for us as we look forward over the next couple of years. So listen, gentlemen, I want to wrap it up there. That's our time. I want to thank you all very much for taking time out of your busy schedules to participate in today's session. And Chris, thank you to the Hong Kong Exchange for the sponsorship. And again, I thank you, and we look forward to keeping in touch with everyone. So have a great day. Thank you.
Hello, and thank you all for attending again on the second day of this Trading Asia event. Please do keep sending through your questions, which is the button just under the video streaming. We're very lucky to have some of our panelists who you just saw join us now here today. I think I'll just jump straight into it because everyone's very busy, of course, as always, and it's Friday. The first question that we've had through is, what would be the key developments to promote the adoption of options in Asia? I'll just set this one open to anyone.
It's Chris, Hong Kong Exchange. I don't mind taking a segment of that. We do a lot of, we have a sales force, a small sales force, but a sales force which is out there selling all our products. And we're very keen on the entire options suite, and we like to get futures and stocks and ETFs and whatever we can and launch options on those pretty much as soon as we can. And as I said in the panel, we've started doing it on some of our IPOs on day one, which has had its own challenges, but we've successfully done it now a few times. So that sales force in itself is out on the street selling to obviously the banks, brokers, and the institutions and buy side, sell side. But also we have quite a strong pull into some of the retail brokers. So we do a lot. We could do more probably, but we're a lot of marketing with the retail brokers to try and help them, and education with the retail brokers to try and help them to bring that kind of retail flow into any of the options. Any of our suite, but obviously the options as well. And as an example, we've done an awful lot of work on our weekly options to make the market understand. We've got the weekly options in the Hang Seng. They're in the after hours. We see good traction in the after hours, and I think some of that is retail sitting at home in the evening, trading our after hours Hang Seng weekly options. So I think we're doing a lot of marketing events, I guess, publicity marketing, particularly with retail, and then obviously through to the institutions. So we try and work with brokers a lot to do that, if that answers any part of the question.
Yeah, thank you so much. I'll just pass on straight to the next one then. Can you share more on the upcoming options contract in Asia for both commodities and financial options? Will mainland China surpass the rest of Asia in terms of options, product development, and trading volume? I suppose it's slightly directed at Charles, really.
Yep. So we onshore in China. We are quoting the option market on screen. I would say the option market at the moment, even though late last year and early this year, we saw a bunch of new options got listed on the commodities and ETF and index. I would say the option market is still developing itself. So for the investors to get to know the products onshore, for the regulators and exchange to see how the market is developing. But obviously, in March and July, we've a bit of a volatility in the markets that attracts more volumes naturally towards the options market. And also the regulators have said many times that they want to launch options under every liquid commodities underlying currently existing in the market. So yeah, I think with more investors understand the market, and also the appetite from the exchange and regulators to launch more products, you will see quite a exponential growth in the option space in China.
Thank you. And another one we've got here is, what's your view on investor sentiment in the listed options markets in the next 6 to 12 months, given the market volatility?
I'll continue on these. I think it's a slightly different investor sentiment between the commodity option space and the equity option space. In the equity option space, I think you get a much broader range of investors coming from the local hedge funds, or they call it private equity funds. You have a bit of a retail investors. You have some long only funds that to manage the positions. You have equity brokers, their own prop trading desk that's using these products. So it's quite a wide range of investors. In the commodity space, I would say it's probably predominantly the local hedge funds, a bit of industrial players to hedge their own inventories or their raw materials. You see the local futures brokerage arms that will go out to reach out those end users to try to issue them some structured products to help them to manage their inventory and raw material risk. So that's quite a big chunk of that. You also see some international trading houses. For example, Louis Dreyfus, Cargill's, Trafigura, and this kind of guys also using the local commodity options market. I would say for the next 6 to 12 months, it will be continue to be these kind of people that dominating the market.
Oh no, just in terms of real investor sentiment, given the, let's say, I would say a large overhang of the U.S. elections, we would see that at least the coming 6 months in general in Asia, I think in terms of taking large positioning, everybody is more on the cautious side, obviously. Maybe with the exception of currently, as you see in the tech sector.
Yeah, I think I agree with Robert. I think there has been a sort of an increase in retail activity, I think, on the back of larger volatility that we've seen in the market. Also, obviously, the market went down a lot, and I think retail started buying and has made a lot of money on average. So they want to keep trading. Also, maybe thanks to the introduction of the weekly options that are at a lower premium, which makes them more attractive to retail. I do think we see fewer large risky positions being put on by banks or institutional funds, and also I think people are more wary of downside protection and don't sell as many puts as they used to do when realized volatility would not be as high as it has been.
Well, actually, it kind of reminds me of a session we had the other day where they were saying that people were actually being more cautious because they were also trading from home, and the behavior that no one wanted to be the person that was going to blow up while working away. So I wonder if that's also been having an impact on the behavior of the markets.
I think it definitely had in April and May, for instance, when the market was really, especially May, was very, very quiet, I think. And also there was obviously massive moves in February and March. So a lot of people would have either made or lost a lot of money. People who've made a lot of money are probably less keen to trade, and people who've lost a lot of money are also less keen to trade. Then on top of that, everyone is either working from home or is scared to work from home in the near future. So there's just a lot of uncertainty that will impact the trading activity. I feel that around the world, I think people have either gotten used to the working from home, or in some countries more people are returning to work. So I guess that will that effect is diminishing at this point.
So it will level out in the coming months going ahead, you think, and go back to, say, the new normal, but more normal than we've seen at the beginning of the year?
Yes. Yeah.
Would you all agree that options have recently been used for massive leveraged bets to speculate in markets regarding SoftBank, and this results in excessive volatility in the markets, even in commodity markets like iron ore?
I think it's pretty clear now that SoftBank has still has some large positioning in the market, but obviously that's more linked to the tech sector. So I wouldn't immediately, let's say, blame SoftBank for volatility in the iron ore space. What you did see in the last few weeks was some additional volatility in the tech sector, also on the upside. So for a lot of investors that are long the tech sector, it's not necessarily bad. I also would like to add that obviously SoftBank did not have any positioning at the beginning of the year when we had even more volatility than we were having now because of the COVID. So yes, there's always larger parties with larger positioning, and I think that's not going to change.
And Jos, were you going to comment as well, or?
I mean, it's going to be very similar. My contribution would be that obviously SoftBank has large positions, but if you look at the total open interest in like the combined sort of tech stock calls at the time, like there is also a lot of retail and a lot of other players that contribute to that. Obviously SoftBank was the largest, but you can't just blame SoftBank on their own for like Nasdaq volatility, I would say.
Yeah, causality and correlation and like the differences, just because something seems to be happening because of it, that they can be completely unrelated.
Yeah, it will have contributed for sure, but I don't think that they're the only cause. Yeah.
Well, with that, I think we're going to end the session. I'd like to thank all the panelists so much for your time and for the attendees for joining, of course.